Today on InvestTalk, we look at the factors that are likely to mean value investing will outperform in the years ahead. We then unpack the market sell-off today. Then we answer questions about Williams-Sonoma, American Electric Power, Southern Copper, and more. And then at the end, I look at why thematic ETFs are terrible investments.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point today concerns this story about value investing's comeback and 4 reasons it's set to outperform growth. Now, investing with a focus on identifying undervalued stocks rather than just chasing those high-flying, fast-growing companies, that floundered. Basically starting in 2007 and up until basically summer of 2020. That's when the growth side of the market peaked out. You had a bit of a counter trend rally from the beginning of last year up until recently. June is basically when that value side started to outperform once again. And there are 4 reasons why value is likely to do very well in the years ahead. Now, the first is they're cheap. Yeah, you might say, okay, they're value stocks. They're cheap. They're going to look cheaper. Based on a lot of different metrics. But if you look at value stocks and the ratio of book value compared to the growth side of the market, they typically are about 25% as expensive as the growth stock. So if the average growth stock is trading at 4 times book, I'm just using easy numbers here, then the average value stock would trade at 1 times book. Okay. And that's kind of the longer term average. But lately, it's gotten extremely cheap. And currently, it's now trading at 1/8. So it's basically 12%. Okay, so that ratio has been cut in half compared to what it typically is. So you're going to get a doubling of value stocks and growth stocks going flat. And that would bring you back to the longer term average of the difference between the growth stock valuations and value stock valuations. So that's number 1. Value is very, very cheap historically. Now, if you go back to like 2007, that ratio peaked out at about 40%, 40%. And historically, when it's that high, then it's set to underperform. And obviously it did in subsequent years. And so that's number 1. Value remains extremely cheap, near the lowest levels in history. Now, the second is the prolonged underperformance of value was not due to the fundamentals actually being better. Meaning, it's not like growth stocks from an earnings perspective, on average, did so much better than the value side of the market. It was really multiple expansion. Okay? And if the relative book value in 2005, 2007, when value last peaked out, if that had been maintained, value would have outperformed growth over the entire span since 2007. So it didn't. So basically, the book values of the growth side of the market rose without, the price to book values rose without the book values really moving very much. Okay, so it was just all based on not a whole lot. It really wasn't a lot of value creation there when it comes to the growth side of the market and how much profits they were actually producing. Okay, so those are the top 2. Number 3, value reliably beats growth during periods of rising inflation. Why is that? Because rising inflation means rising interest rates, and the discount mechanism, when you do a discounted cash flow, says that those cash flows way out into the future on the growth side are discounted at a much higher rate, which makes them less valuable today. So basically, higher inflation means higher volatility in the economy as well, and markets, and in the political arena. And in a riskier world, investors want a margin of safety, and so they tend to flock towards those value names on top of it. So higher inflation simply means value tends to outperform. And yes, inflation has come down, but look at what's happening now. You have inflation that's in the 3% range, and the Fed is starting to cut rates. So what do you think? Do you think that inflation is going to head back down towards 2 in an easing environment from the Fed? Or do you think it's going to head back towards 4 and higher? I'm going to go with the latter. And that is an inflationary environment that is bad for the growth side of the market. And the last one is growth beats value usually in the late stages of a bull market. Okay. And that's, most likely what we are in. Okay. And the big question is, when should you add value exposure? Probably now. And you want to look at things like price to sales, price to book, price to cash flow, dividend yields, etc. And at the bare minimum, you need more balance in your portfolio. If you're just indexing, you're leaning on the growth side of the market. So how do you start to have that value tilt? There's a lot of ways to do that, from individual stocks to ETFs, but obviously just owning the indexes, owning a target dated fund, for example, as well, those are simply ways to be tilted on the growth side of the market. And so for all those reasons, it makes sense to start to tilt to the left, tilt to the value side, and you are likely to do better into the future. Now let's take a look at the market today. It was a red day. You definitely could say that. And it was really on the back of an ISM manufacturing PMI report that came in at 47.2, which was definitely worse than expected. And you had major sell-offs in the growth side of the market. And you had large cap growth down 3%, small cap growth down 3.15%. Large cap value was down less than 1%. So you saw the large divergence there. And you continue to see a market that is choppy, and that's what I was expecting. I've been saying this for a couple of months now, that this is likely a market that it will grind for between now and, say, the election day, around that time, and then we likely get a year-end rally. Typically, when you go into, let's say, the Thanksgiving Day holiday with a positive market, you tend to get kind of a float up from there until year end. So I still kind of expect that, but doesn't mean we can't have a rougher September. And obviously, the first trading day September was not great. And so I continue to think that you'll get a market rotation out of the growth side of the market and into the value side. Names like NVIDIA down 7% today, even though you had those good earnings a couple days ago, but the market didn't really respond very well to it. And now it's gone from 130 to 108 in just the span of a week. And so you're definitely getting the NASDAQ well off the highs, even though the S&P is still not far from its all-time highs, even after the sell-off today. So I continue to see a market where the economy is weakening, and the Fed is set to cut rates. They already talked about that. We know they're going to cut at least 25 basis points on the 18th. We're now 15 days away from that meeting, and there'll be more color of not just about what is the move in on that meeting, but what will the move be between now and year end. And the market is now priced in between now and the end of the year about 100 basis points of cuts, maybe a bit more. And so there's only 3 meetings left. That means one of these is likely to be 25 basis points. Now, could that be more towards after the election, November 7th? I believe it's a day or two after the election. So that's the following Fed meeting, and that could be the time where they get more aggressive on a rate cut. But certainly the economy remains weak-ish, and a rate cut is likely to mean positive impulses for credit availability, credit creation, and we know the government continues to spend as well. So when you have those two things in line, it's hard to get a major drop in markets, major deflationary impulse. So this month of September may be more volatile, but it's likely to be something similar to what we saw in July as well. So that's where we're at, and we'll see as the markets, as we go into Friday. Friday, we do have the jobs number, and that will be important to what the Fed does at its meeting.
Hey, Luke and Justin, really appreciate all the stuff you guys do on the show for us. I had a question about a company, Williams-Sonoma, stock symbol WSM, would like to know your expert analysis on Williams-Sonoma. Thank you so much.
All right, looking at Williams-Sonoma, this is a name that we have owned for clients for some time. We were buying it back in was it late 2022, early 2023 in the $50 to $60 range, and now it's at $131. Now it has pulled back a bit from its high around $173, but in general, this is more of a consolidation period. And we really like the company. Why? Because they are the premium brand when it comes to home cooking gear. Obviously, they own Pottery Barn, so they sell furniture, and many people are investing in their homes because they're spending more time working from home, they're cooking at home, etc. And so, and then health is important. So a lot of people are cooking more at home because of the cost of eating out, and that means buying more dishware, pots and pans, etc. And so Williams-Sonoma is kind of the premium brand in the space, and their profitability is very, very high. Return on equity, 54%. Now that's down from the high of around 81% back in the fall of 2022, but still 54% is very, very healthy. And they have net cash on their balance sheet. So no debt, no long-term debt to speak of, $1.2 billion in free cash flow on a market cap of or enterprise value of nearly $16 billion. So that's a pretty healthy free cash flow yield in the high single digit range. Now, is it going to stay as healthy, as the consumer continues to slow down? Probably not. You're getting earnings expected growth of this year, 9% and 1% next year. And so I think that's where you're going through this kind of consolidation period to see, where does earnings level out at? If it stays in this $8 range, it's certainly undervalued. If it sets back to closer to $4 or $5 like it was pre-pandemic, then that would be something to worry about. But overall, we like the business, we like the profitability, and we would continue to buy Williams-Sonoma on some dips. Although near term, it's kind of neutral, but long term, it remains pretty bullish. So that's Williams-Sonoma, one of the best in the space when it comes to homeware, and one of the most profitable companies with the best balance sheet. So that's Williams-Sonoma, and we give it a thumbs up. We will grab another caller question now from the InvestTalk voice bank.
Hey, Justin and Luke, this is Jason from Atlanta. Hey, I was calling about Aehr Test Systems, Aehr, with all the hype around data centers and EVs, GPUs and CPUs. This is a small company that does all the high-end burn-in testing for the CPUs and GPUs for both data centers and any other kind of application for them. So I was wondering maybe if this was a good play to get into. I was just wondering your thoughts. All right, I appreciate it. I'll listen to it on the show. Thanks.
All right. Aehr Test Systems engaged in test systems for burning in and testing logical, optical, and memory integrated circuits, increasing quality and reliability needed for automotive and mobility integrated circuits. Okay, so this is a name that did very, very well for a bit. It was losing money pre-pandemic up until 2022, which a couple of years ago. Started to make money, and then this year, for 2024, expected to make full year $1.21, and it's trading at $13.51. So you're saying, okay, it was losing money just a couple of years ago. Now it's making $1.21. That's about 10 times 11 times the current price that it's trading at. That looks cheap with that level of growth, right? Problem is that growth is reversing dramatically. Next fiscal year is supposed to earn only 30 cents per share, down 75%. And if you look at the last couple of quarters, revenues were down 25% last quarter and 56% the quarter before that. And the stock, there's a reason the stock is down from 52 all the way down to $13.51 at the close today. So I don't love the technical trends, definitely looking pretty poor. It's a small cap name with a market cap of only, where'd my cursor go? Sometimes my cursor wants to disappear on me. There we go. $400 million market cap, so definitely a small cap name here. No debt, that's good. I like that. What are they doing with their shares? Are they issuing more shares? Yeah, they continue to issue more and more shares, and that's really a problem for me. over the last 5 years, they've gone from 22 million shares outstanding all the way to nearly 30 million shares outstanding today, and that recently increased. So I like that. I like the surge, but that's what happens with these small cap names. You get a surge, they might get some big orders, but it's more of a flash in the pan. And to me, this looks like a flash in the pan more than a sustainable business that excites me. It looks like a short-term anomaly, and I don't like to buy those businesses. I like to buy the businesses that have strong long-term trends and consistency, and this is definitely not it. So I'm passing on Aehr Test Systems. Now let's go to a live caller. Dan in Walnut Creek, you're looking at AEP, which is American Electric Power Corp. This is actually a name we own for clients, but let me hear your take, Dan.
Okay. Hi, Justin. Thanks for taking my call. Yeah, I've got this. I own this stock now, and it's doing pretty well for me. And I was thinking of adding, but when I look at the statistics, the numbers don't look that great. And I was wondering what you guys thought of it. If you own it, I guess you like it.
Yeah, we do like it. When you say it doesn't look that great, what about it? Or do you think it doesn't look that great?
Well, I'm looking. My tool is kind of limited, but I'm looking at total debt $44.34 billion, and the market cap is $54 billion. The return on equity is like 10%. I guess the forward PE is like 17, down from the current 20. I guess that's okay. So I wasn't sure because it's doing quite well. I was thinking of adding to it, but when I started looking at the numbers, I started questioning it.
Yeah, well, the first thing you have to understand about utilities is that they're highly capital intensive, right? You're building massive infrastructure, and they tend to carry a good amount of debt. So I don't really see an issue with that because these are businesses that print money. Their profits are legislated in, and the return on equity of 10% doesn't sound very high in an aggregate. If you're looking at all the stocks in the universe, it's not. But if you're looking at utility companies, that's a pretty healthy profit margin or profit metric, shall we say. And so utilities, long term, and for everyone else out there, this is American Electric Power. This is a utility company that operates in 11 states. You're talking about Arkansas, Indiana, Kentucky, Louisiana, Michigan, Ohio, Oklahoma, Tennessee, Texas, West Virginia, and Virginia. And so this is, from a geographic standpoint, this is an area where a lot of people are moving, a lot of businesses are moving there, factories being set up, data centers being set up. And so there's a lot of power demand there. And from you're looking at other utilities, it is definitely one of the better utilities out there. So remember, you have to look at this compared to others within the industry. And all of this lines up to this being definitely one of the best in the industry. And so if you want utility exposure, you're definitely going to do a lot worse than American Electric Power. Now, let's go talk to John in St. Louis. He wants to talk about portfolio management.
Hi. I was just calling to see if there was any set number of stocks that I should hold in a taxable portfolio. The reason I'm asking, I heard somewhere that that typically you want around 20 stocks in a taxable if you're just trading stock or investing in stocks. In order to be well diversified and be able to stomach volatility. And on that note, I'm just kind of getting going with building a portfolio. And right now, because I don't have like 20 stocks in it yet, my weighting in certain stocks when I put them in, when I buy them, says it's like way higher than I know you would, if I were to call in and be like, my weighting in this particular stock is this, it'll be like, whoa. So should I get like a kind of a broad ETF until I fill up with my set number of stocks to kind of get those other numbers and kind of put money in that broad ETF and have my other stocks kind of weighted down that way? Or should I just keep chugging along and adding as I can, and then eventually the weights will be where they should be?
Yeah, I mean, the 20 range is kind of the start of having strong portfolio diversification. And so if you think of 20 names, that's 5% of the portfolio each. So, that's typically around the limit we like to have of any one position, around the 5% mark. And that gives that broader diversification where if any one position kind of takes it on the chin, you're not blowing up the whole portfolio. And so as you're building out your portfolio, if you don't feel like you have 20 names to invest in, then you could put the balance, having everything 5% or less, and then the balance into some broad ETF is a good way to do it until you are able to find enough names that to build out a portfolio, a well-diversified portfolio. And then you have to also think about, the sectors as well. So it's not just about the total number of stocks. If you have 20 tech stocks, right, then that's not diversified. So diversify among these sectors as well. Now you can get too diversified as well. So I think anything over, say, 50 names is probably too much. So in that 20 to 50 range is probably where you want to be. And have them relatively fairly balanced. And so that's the general guide to think about how to build a portfolio when you're buying individual names. Now let's keep things going and swing back to the InvestTalk voice bank. And you know the number to call. It's always 888-99-CHART.
Hi, InvestTalk. I had a question on contributing to a Roth IRA. I'm currently at a point where I'm very close to reaching the max income limit in order to qualify for contributing to a Roth IRA. I'm curious for your clients who hopefully are in a similar situation and you guys have experience with, how they approach it. Do they just do like a $600 each month to hit the max limit, and at the end of the year then decide whether they want to, or whether they qualified and can keep it, or if they have to take it out? Like, is that a lot of work, or do you recommend waiting until the following year since you can still make contributions in the next year up until tax day? Or if there's like another way around it to, limit the headache of having to pull money out later, or if it's really not a headache at all, it takes a day to fix that mistake. And I'm just curious to see what you have done with your other clients. I've heard some people will do contributions to a traditional IRA, and assuming they're still under the income limits, will just do a conversion. But then that puts you in the next year, and that seems kind of confusing and probably more of a headache. So, if you got thoughts on that too, that'd be great. And I'll listen on the show. Thanks.
Good question. Typically it's easy to reverse a Roth IRA contribution in a particular year. So that's something that you want to talk to your CPA about to see if you qualify. It's at least at Schwab, we've done it before. Not super often, but it's definitely happened. And we always say getting it in earlier is better. And then if you do have to unwind it, you have to unwind it. It's pretty easy. So I would focus more on the habit of making that contribution. And then if you do go over your limit, then you can unwind it before the tax day. Okay. Now, I hope you've been telling your friends about the InvestTalk audio podcast being available in video form over on our YouTube channel. And we get questions submitted via the comment section over there as well. So let's tackle one of those questions that came in recently. Let's see. Wedam Savad said, SCCO has been falling for a few months. Is the copper trade over, or should I be looking for a price to pick up some more shares? So near term, copper is under some pressure, mainly because of China and their real estate market. And they're trying to refocus their efforts on other avenues of economic growth than real estate, which takes a lot of copper typically. That's the negative for copper, really. They've been selling off a lot of copper inventory to the global markets in the near term, and that's weighed on prices. But long term, we see it as a bullish backdrop for copper. Number one is there's just a lot of demand coming from EVs. Number one, just the amount of copper that goes into electric cars is 5 to 8 times as much as a traditional internal combustion engine car. And you have the demand for example, AI and these data centers that are processing AI applications. And so that takes a ton of copper wire as well. So those two things are driving the demand side. But what's even more important, really, over the long term is the lack of copper supply, new copper supply that is coming online. And that's the issue. And, near term, you're getting some of that supply out of China, but that's not sustainable, right? They're not going to sell, they don't have unlimited amounts of copper that's going to ebb at some point. We think sometime next year. And so we think this sell-off in copper in general and SCCO is something to pick up more shares, not get too spooked about, especially if you look at a longer term chart. Nothing's really changed. It was overbought a couple months ago, and it's now pulled back to the 50-week moving average. That's no problem, right? Still making a series of higher highs and higher lows. It's moved from 128 or so, 129 to 96 today, and that's seems like a lot, but in the commodity industry, that's normal volatility. And if you can't stomach that volatility, you probably shouldn't just be in commodity names in general, because that's the type of pullbacks that happen. But those are typically, as long as there's structural positive aspects to that commodity market, those are pullbacks you want to buy. And we think that is the case with copper in general. Thanks for the call. Now let's talk a bit about thematic ETFs. I love this topic. This is amazing. And there are 3 AI-themed ETFs that have managed to lose money this year. 3 of them. Okay? Despite the big gains in NVIDIA and Supermicro and many others. And this is really a cautionary tale for buying thematic ETFs. And these thematic ETFs cover more than just AI, robotics. They also cover things like carbon permits and Chinese cloud computing and pet care and all over the board. And the simple answer to this is you're probably going to buy at the wrong time. And you aren't going to hold on long enough for it to make good returns for you. Simple as that. Now, one of the big reasons why some of these AI ETFs haven't done very well and are actually down on the year is because they haven't owned enough of the big winners. NVIDIA, for example. One of these only it's owned less than 1% of NVIDIA of the fund. Another is only 3% of NVIDIA. And another one, a BlackRock one, which is the biggest of these 3, it recently changed its entire weighting 3 weeks ago and altered its purpose from robotics and AI, changed its ticker symbol, and switched to a market value-based index that gives it larger exposure to NVIDIA. Already after NVIDIA's run, and now it's doing poorly. And as I said at the top of the show, there's a 20 percentage point gap between the best and worst AI ETFs this year. And if you go all the way back to November of 2022, there's a 60 point gap. Okay? And there are so many lessons here. The basic one is picking among funds within a theme is hard. There's a lot of luck involved, and it's all about the weightings of the portfolio, the type of companies it tends to buy, and how it defines a company within that space. Right? What may be an AI play to you may not be to a particular ETF because it doesn't fit certain criteria. Now, the major lesson, that's the basic lesson. The major lesson is that it's hard to pick a theme in the first place and stick with it. Because defining a theme is hard. What makes something AI? There's ones that are more obvious, like NVIDIA, but what about companies that simply are benefiting from AI and its efficiency? A lot of time, those are less obvious. And then you go into other types of themes like clean energy. How much clean energy does a company have to dedicate their business to make it qualify as a clean energy company? And the major one that's hard is the timing. Timing the theme is the hardest. You get in too early, there aren't enough companies to buy. You get in too late, already when the funds have launched, chances are the theme is already well known, overpriced into the stock, and you're buying these names at very expensive levels. And so these thematic ETFs play to our worst instincts because it's all about narrative. And we know long-term narrative is nonsense. Businesses, quality businesses are what matters. A good example of this was clean energy ETFs back in 2020 and 2021. That's when a lot of these were launched. And the performance has been miserable since then. Many of them are down over 50%. And a paper issued by Ohio State University and 3 fellow academics looked at what they call specialized ETFs. And what it showed was that they lose 6% a year on average in their first 5 years due to poor launch timing. So that's what you should expect. When you see a new thematic ETF, some cool new sexy name, the odds on average are that it will lose 6% a year for the first 5 years. Think about that. Think how bad that is. It's horrendous. And can you hold on through those rough times and make it out the other end? Unlikely. You're going to get fed up and, sell probably at the worst time. So take these lessons. Don't get caught up in the thematic ETFs. They're some of the worst investments that you can make.
I've got a position, about 20 shares in a stock, ICICI Bank Limited. IBN is the stock symbol. And I was wondering if I should start selling some of this off or just hang on to it. Thanks a lot for your answer.
All right, looking at IBN as a symbol, and Steve used to call this Icky Bank. I don't think that's how you pronounce it. It's just ICICI Bank. This is an Indian bank, one of the biggest and longest lasting ones out there. And this would be just a general bullish bet on the Indian economy. And frankly, I kind of like it. Now, it's a bit expensive after this run. Sure, maybe. And earnings expectations are coming down for this year and next year. But I don't know what it is a percentage of your portfolio, but I don't see any reason to sell it. It's in an uptrend. It's making higher highs and higher lows. The Indian economy is of the developed economies or developing economies is performing very, very well. And I would continue to hold it. This is a good way to play the Indian economy. So I'd hold IBN, ICICI Bank. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we'd like to thank them for the courtesy by getting to their questions quickly. Puma51 says, do you have a broad index to follow for the housing market? Well, that's difficult. There is the Case-Shiller index, but it's extremely lagging. It gives prices, talking 6, 9, 12 months ago. It just is a very bad index to understand where housing prices are going right now. So I wouldn't use that one. I think the best one is just simply ITB. That's an ETF, and it's following the home builders. And that is going to give you a much better real-time look on what the housing market is doing. Why? Because the market is going to continue to price in earnings expectations for the housing stocks, right? And so if those estimates continue to go up or they go down based on interest rate movements, the broad economy, et cetera, then those housing stocks will move as well. And so I would not use the Case-Shiller index. It gets a lot of headlines, but it's not that good. So I would go with ITB. That's the best one to look at. Now let's squeeze one more question in now.
I have a question over a REIT, Medical Properties Trust. MPW is the ticker symbol. I was looking to get started in a small position. So just want to see what you guys think about it. Thank you.
All right. Medical Properties Trust. People have been talking about this for going on 2 years. They're chasing yield. And it sounds great, right? You're getting it right now. It's the yield 7%. It's medical properties. A lot of people think medical properties, it is safe. Problem is that this is a company that has been lending basically to their tenants, and a lot of their tenants are very low quality tenants, meaning they're on the brink of bankruptcy. I think one recently filed for bankruptcy. There's been a ton of issues, and the safety of their cash flow is greatly in question, and that's why this continues to head lower. And their funds from operation, free cash flow, was at $811 million at the end of 2021. Now it's at 403. So that's been cut in half because their tenants have been struggling, and the return on equity is negative 23% here. And what you are doing is you are chasing the yield, and you're not doing the research. And that's everyone out there. And you're not the only one calling about this. A dozen people have called about this. And it just shows that the average person isn't thinking about these companies, or these, in this case, a REIT, in the proper way. They're not looking at the profitability. They're simply looking at a name. They're simply looking at the yield, and they don't understand the business. You need to do your due diligence. You need to do your research. And this is a dumpster fire, and you want to run away from it as fast as you possibly can. Thanks for the call. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about a free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And I hope you've heard that the InvestTalk podcast is also available in video form over on our YouTube channel. So go over there and check us out. Independent thinking, shared success. This is InvestTalk. Good night.